Welcome to the deep dive. So, Best Buy just dropped their Q3 fiscal 26 results.
They did.
And on the surface, it looks like an absolute operational beat. I mean, really strong.
Oh, for sure.
But then you look at the forward guidance for Q4, the huge holiday quarter, and it's really cautious.
It is. And that divergence, that's the whole story right there. It's what we need to unpack for you.
So we're diving deep into the earnings call to figure out, why that immediate success seems to conflict with what they expect for the future.
Exactly. Q3 shows this real resilience, especially when there's real tech innovation driving it. But management is clearly seeing some headwinds.
Some tough comparisons coming up.
Right. So our mission here is to figure out what drove that fantastic Q3 and then how they're planning to navigate what comes next.
Okay, so let's set the stage with just how good Q3 was. Let's start there.
Let's do it.
Enterprise revenue came in at $9.7 billion, and comparable sales growth was 2.7%.
Which was way better than anyone was expecting.
Right. They were guiding for something much closer to what we saw in Q2, which was slower.
And that outperformance, it flowed right down to the bottom line.
Which is always a good sign.
Always. It shows tight operational control. So adjusted earnings per share, that was up 11% year over year to $1.40.
And the financial nerds, like us, we were looking at the adjusted operating income rate.
Yes, 4.0%. And that came in 30 basis points better than expectations.
Okay, wait, let's pause there. 30 basis points. For anyone listening who isn't totally into the jargon, what does that actually mean in this context?
Good question. A basis point is just 1/100th of a percentage point. So 30 basis points is 0.3%.
Doesn't sound like a lot.
But in retail, where your margins can be razor thin, that is a really significant beat on profitability.
So it wasn't just because they sold more stuff.
No, that's the key. It was a dual win. Higher sales, yes, but also really tight control over their SG&A.
Their operational costs, basically.
Exactly. Selling, general, and administrative expenses. They kept a lid on costs while sales went up.
They also gave us a look at the monthly sales trends, which I thought was interesting.
Yeah, that cadence tells a story.
So they said August was up about 3%, then September was the slow month, only up 1%.
Which they kind of tied to that post-Labor Day lull.
But then October just roared back, up 5%.
Ah.
And they credited those Techtober sales events.
And that right there, that reinforces what management is calling their core innovation thesis.
Meaning the success wasn't just everywhere.
No, not at all. It was really concentrated in areas where customers either had to buy something out of necessity or where there was genuinely new, exciting tech to get their hands on.
Okay, let's drill into those winners then. Computing was a big one.
Huge.
7th consecutive quarter of positive comps. I mean, that's a remarkable streak for what people think of as a mature category.
It is, but part of it is a forced hand. A lot of that momentum is from customers needing to upgrade.
Right, the Windows 10 support deadline.
Exactly. Microsoft's support ended mid-October. Best Buy absolutely capitalized on that. They saw almost 30% year-over-year growth in desktop computers.
Desktops. You don't usually see that kind of spike in desktops.
You really don't.
So here's a question then. Is that a real sign of fundamental strength? Or is it just, a one-time event? Once those Windows 10 users are done upgrading, does that streak just vanish?
That is the critical long-term question. Management is betting the next wave is AI-enabled PCs.
Of course.
But for Q3, yeah, a lot of it was that Windows 10 retirement cycle. They also saw really strong results in gaming and mobile.
The Nintendo Switch 2 is still doing well.
Still performing, yeah. Though the growth rate is slowing down a bit, which is natural after that massive launch spike in Q2.
And mobile phones saw strong growth, which is interesting. Margins there can be tough.
They can be. But they said it was because of better carrier partnerships and just improving how they operate in the store.
So they're using the physical stores for that high-touch service and sign-up process.
That's it. It shows the value of having that physical footprint. People still want to touch and feel a new phone or a pair of AR glasses before they drop that much money.
But it wasn't all good news.
No, definitely not.
Declines continued in some core areas. Home theater, appliances, drones.
And that tells you that the consumer is still very, very deal-focused when it comes to discretionary spending.
Absolutely. Management kept saying customers are resilient, but they'll only spend on the big-ticket items under 2 conditions.
First, clear necessity. Your fridge breaks, you have to buy a new one. They call it a duress purchase.
Right.
Second, true technology innovation. The Switch 2, an AI PC, something actually new.
And if it's in the middle, like just a standard TV upgrade.
They wait. They wait for the deepest possible discount.
Which I think leads us perfectly into their bigger strategy. Because you can't just rely on tech cycles.
No?
You have to look at how they're fundamentally changing what happens inside the stores themselves.
Exactly. They're trying to turn that huge real estate footprint from a liability into a platform for unique experiences.
The Meta AI glasses rollout seems like a perfect example of that.
It is. They launched them in all stores, but in over 50 of them, they've built these immersive showcase areas staffed by actual Meta experts.
And the data on that is really telling. Demand for the in-person demos is actually outpacing the appointment slots they have available.
Which tells you everything you need to know. For new, novel tech, the physical store is essential.
And then you have the IKEA pilot.
Which is maybe the most audacious move of all.
Yeah. Big 10,000 square foot areas staffed by IKEA coworkers showing off kitchens and laundry rooms.
And this is the first time IKEA products are being sold through another major retailer in the US.
I mean, it's bold. It makes sense for appliances, which is a weak spot for them.
Yeah.
But does it, I don't know, dilute the Best Buy brand? Is the end game here?
The end game is margin and density. They have all this extra space in their stores. IKEA brings in high-value traffic for planned, big-ticket purchases.
And Best Buy can attach their own services and installation.
Exactly. It turns empty floor space into a shared, high-margin showroom.
And at the same time, they're not ignoring digital. Online sales were up again.
Fourth consecutive quarter, and a big piece of that was the delivery window expansion.
Right. Now all markets can get a 2-hour delivery window up to a week out.
That's a huge operational upgrade. It used to be only in about a third of their markets. For big items, that certainty is critical.
And it sounds like the vendors are buying in too.
They are. Vendor labor investment, so money from Sony, Samsung, Meta is expected to be up 20% in the second half of the year. That's a huge vote of confidence.
Okay, so let's shift to what I think is the real long-term story here. The structural change.
The new high-margin profit streams.
And the marketplace and the retail media network. This is where the whole investment narrative is going.
Absolutely. And the marketplace has ramped up incredibly fast. 3 months in, over 1,000 sellers.
Which has led to 11 times more SKUs online.
An incredible number. They're getting into totally new categories like licensed sports gear.
But the big question with any marketplace is quality control.
Right.
How do you maintain the brand standard with 1,000 different third-party sellers?
It's the key challenge, and they shared 2 metrics that suggest it's going well so far.
Okay.
First, the marketplace sales actually had a positive impact on the gross profit rate, so higher margin sales.
And second,
customer return rates for marketplace items are running lower than for their own first-party items.
Lower returns, that seems completely counterintuitive.
It does, but over 80% of those returns are happening in the store.
Ah, so it's a traffic driver.
It's gold. It gets people back into a physical location where they might make another purchase.
And then there's the other side of the coin, the retail media network. Best Buy ads.
The current darling of the retail world. Management was very clear this business is already highly profitable.
This is where they sell ad space across their whole digital ecosystem.
And physical. And they launched their self-serve My Ads platform to make it easier for smaller brands to get in on it.
And they're expanding into what they call non-endemic verticals. Let's make sure we define that clearly for everyone listening.
Excellent point. So endemic partners are the ones you'd expect. Samsung, Logitech, companies that sell electronics.
Right.
Non-endemic partners are companies that just want access to the Best Buy customer. You know, a high-value, high-income shopper.
Like who?
Financial services is a big one. Think PayPal, Capital One. They're running campaigns. And all of that ad revenue is significantly boosting the company's overall gross profit rate.
Now, before we look forward, we have to touch on a key financial move they made, the SG&A control.
The AI push.
They're using AI in customer support, and it led to a 17% drop in customer contacts in Q3 alone.
It's also optimizing fulfillment. AI is now choosing the most efficient place to ship from for over 70% of online orders.
So they're getting leaner.
Yeah.
But we also have to talk about the elephant in the room.
Through Best Buy health impairment.
Yeah. A $192 million non-cash impairment charge. That's a huge number.
It is.
Was this just management, smartly cutting off a limb that wasn't going to grow?
I think that's exactly what it was. The segment was facing huge pressure from the Medicaid and Medicare markets. The long-term projections look bad.
So they took the hit.
They took the hit, which lets them focus capital and talent on the high-growth stuff, like the marketplace and the ad network. And it's really important to remember that charge was excluded from the adjusted results we were talking about earlier.
Okay, so a blowout Q3, aggressive cost control, shedding a legacy business, investing in the future. So what does management see for Q4 that makes them so cautious?
And this is where the story gets really tricky. They're guiding for Q4 comps to be somewhere between down 1% and up 1%.
Wow, that is a huge step back from 2.7% growth.
It is, but it reflects much, much tougher comparisons. Q4 last year actually saw growth, whereas Q3 last year was under more pressure. They're planning for a bumpy holiday season.
And what about by category? What's the outlook there?
Computing is still expected to be a growth driver. You've got the AI PC hype and still millions of Windows 10 upgrades left. Mobile phones, too, should keep growing.
But gaming is slowing down.
It is. Switch 2 helps, but the PS5 and Xbox are just getting later in their life cycles. Demand is flattening.
And TVs.
They expect improvement, but it sounds like they're going to have to buy those sales. They talked about sharp pricing, more marketing, more labor. That screams margin pressure.
And the most challenging category is still appliances.
Still appliances. They describe the market as being all about those duress purchases.
People only buying when something breaks.
Exactly. So your normal promotions, your 10% off sales, they don't really work. People are buying out of need, not want.
So what's the plan there?
They're shifting focus almost entirely to delivery speed. Because if your fridge breaks, you don't care about a small discount. You care about getting a new one tomorrow.
And if we tie all that back to the full year forecast, the adjusted operating income rate is now expected to be neutral compared to last year.
Which is a slight downgrade.
So what's driving that?
It confirms that even though the ad network and marketplace are great for margins long term, the initial costs to build them out, the tech, the talent, are dragging on profits right now.
The classic investment dilemma.
Build for the future or deliver profit today. They're trying to do both.
All right. It is now time for our favorite segment. This is purely for entertainment. We are not financial advisors.
Please do not take this as financial advice.
But let's hear the pitch. What's an outrageous but plausible investment idea based on this call?
Okay, so think of this as a pitch to an investment committee looking, say, 18 months out.
Got it.
Given the volatility in the core electronics cycle and that big impairment they just took in health, the market is discounting the new structural growth businesses inside the company.
So you're saying the stock price doesn't reflect the value of the high-margin digital stuff?
Exactly. The trade idea is to go long. The argument is that the true value of the retail media network and the marketplace, which are already boosting margins and scaling like crazy, 11x the SKUs, is being totally masked.
Masked by the investment spending and the noise from the legacy business?
Precisely.
So what's the catalyst? What unlocks that hidden value?
The plausible but outrageous catalyst is this. Management recognizes this value gap, and within the next 18 months, they do a targeted spin-off of the highly profitable retail media network.
Wow.
That move would instantly force the market to value the ads business on tech multiples, not retail multiples. And those are exponentially higher. It could unlock a massive amount of hidden value for shareholders.
A highly plausible, wildly entertaining scenario. But again, you are solely responsible for your own investment decisions. This is just a hypothetical discussion.
Right. So, to summarize, Q3 was an undeniable win. Great execution, driven by tech cycles like Windows 11 and the Switch 2, plus excellent cost control.
But the Q4 guidance is a reality check. They're heading into tougher territory, and the whole future growth story is now tied to scaling up ads and marketplace.
They're swapping appliance volatility for high-margin digital annuity streams. That's the trade.
So what's the final takeaway for you, the listener?
Yeah.
Management shared this one fascinating little data point. They said their youngest customers, Gen Z, are really leaning into the store experience. So if you consider that, and you consider their push to fill floor space with partnerships like IKEA and Meta, the provocative thought is this. How long can this physical retail model stay relevant by just consolidating more and more partnerships before the heavy fixed costs of all that real estate finally overwhelm the high-margin digital gains they're making?
And that balance, that tension between the physical store and the digital margin is what Best Buy has to master to thrive. Thank you for joining us on this deep dive.